Today we're talking about my top 5 ETFs and why I think you should invest in ETFs over mutual funds. So over the past 10 years, ETFs have outperformed active money managers by 85%. So what that means is only 15% of active money managers have actually beaten the S&P 500. That should really tell you something, because oftentimes ETFs have significantly lower not only turnover rates but also expense ratios as well, whereas mutual funds can have expense ratios up to 2.5% and sometimes even 3%. That might not sound like a lot, but if you start running some calculators and looking at the compounded cost over time, it can cost you hundreds and even thousands of dollars just when somebody's charging you a couple percentage points to manage your money. So I personally invest in ETFs over mutual funds for several reasons. Number one, they tend to have significantly lower fees, on average around 0.5%, if even that. Most of the ETFs I'll be going into today are going to have fees under 0.2%. Compare that to mutual funds, which have average fees anywhere from 2 to 3 to even upwards to 5% just to manage the money. It doesn't make much sense. If you look at several different calculators out there, you'll see that just a couple percentage or two can cost you not only hundreds of dollars a year, but even thousands of dollars per year as your portfolio continues to grow. So when people ask me, Matt, what is your overall investing strategy? I always like to ask, what would Buffett do? And Buffett did just this. In 2008, he made a $1 million bet with a hedge fund that within 10 years, he would beat their returns simply by investing in an index fund that tracked the S&P 500. Fast forward to 2018, and it wasn't even close. Buffett beat out that hedge fund manager by a country mile and got another $1 million, which is probably a couple bucks to most people. So the main takeaway message from here is that it doesn't take a degree in economics or somebody who's an expert in Wall Street jargon or somebody who's highly intelligent in investing to actually be successful in the stock market. You just have to keep a cool head and make sure to buy when everyone's selling, and always think long term. Don't think 1 year, 2 years, 3 years, or even 5 years. Think 10 years and beyond. So my first ETF that I would recommend is Fidelity's Real Estate Investment Index, or FREL. It currently has a turnover of under 10%, currently sitting at 8%, and offers a very high dividend yield of 4.5%. It also has a very low expense ratio at 0.08%. So what that means is for every $1,000 you invest, it'll cost you $8 to hold that ETF per year. Now the only negative from this ETF that I can see at this point is it has lagged behind the S&P 500 and has only averaged about 6.63% since inception. However, this is a relatively new ETF as Fidelity is starting to expand their footprint in the ETF space and compete with several other favorites like Vanguard and Schwab. But even with that said, I feel like it's still a very attractive ETF. It's a newer ETF. It's offered by Fidelity, which is a fantastic company, and they're currently trying to challenge other giants like Vanguard and Schwab. I think you're going to see this continue to grow throughout the course of its life and pay very healthy dividends. The next one on my list is iShares Core Dividend Growth, or DGRO. So this ETF holds companies such as Home Depot, Verizon, Procter & Gamble, and Visa. It also boasts a very strong average annual return at just over 11% since the inception of it. And it's beaten the S&P 500 currently by about 3% since its inception as well. However, one of my favorite parts about this ETF is it offers a pretty modest dividend at 2.28%. So not only do you get solid growth, but you're going to get really solid dividend returns as well, and you're going to be investing in mostly US-based strong companies that have been around for several decades. However, there's one downside with this ETF, and it is the fact that it has a 26% turnover rate. So what does turnover mean? That means over the course of 1 year, 26% of the holdings are going to be bought and sold somewhere else, or they're going to be switched out. So if they have Home Depot, maybe they switched out for Lowe's. That may not sound like too bad of a thing, but it could affect you in a couple ways. One, It could cause some of the fees to increase at a certain level of time, as it creates more taxable events within the account as well. And additionally, it could also impact your gains, maybe positively, possibly even negatively. Out of all the ETFs I'll be talking about today, this is definitely the most actively managed ETF. So next one on my list is Vanguard's Healthcare ETF, or VHT. So VHT currently has an expense ratio of 0.10%, has a turnover rate of 6%, and it offers a dividend rate of 2%. Now, growth since inception is just a hair above 9% at around 9.58% at the time of this video. This ETF holds several large pharmaceutical companies such as J&J, Pfizer, Merck, and Amgen. So all pretty good, solid companies that have been around for several decades, have weathered the storm, and all these companies have very deep pipelines and very deep pockets and experience between all of them. However, the one downside of the stock is it has trailed below the S&P 500 by a couple percent over the past several years. I think there's a good chance that could change, as the healthcare industry is not going anywhere, and most of that's due to the recent patent cliff, where you've seen a reduction in some blockbuster drugs and other companies trying to grow through acquisitions. And that's causing some investors of these larger companies to be a little shaky. However, I see these companies continue to have solid growth, and I really think it's important that everybody watching has some exposure to the healthcare market. So number 2 on my list is offered by Charles Schwab, and it is the U.S. Broad Market Index Fund, or SCHB. It seeks to invest in the 2,500 largest companies in the Dow Jones Index, not the Dow Jones. The Dow Jones only contains 30 major companies, but more of like an index of the Dow Jones. So with that said, it has an expense ratio of 0.03%, and it's averaged 13.3% since inception. It also offers one of the lowest turnovers on this list at 4%, and it offers a pretty respectable dividend at 1.8%. Finally, it's also just beaten out the S&P 500 since its inception. So I don't really have anything negative to say about this index fund. It's very solid. It gives you a depth of diversity because you're investing in an index of 2,500 companies, and these are all solid, large companies that have been here for several years. I would recommend this to anybody to invest in. So for my number 1 ETF, you guys probably know where I'm going with this. I haven't mentioned them yet, but it's got to be Vanguard's VOO. So VOO simply tracks the S&P 500. It has a low expense ratio of 0.03%, and it also has one of the highest average yields since inception of any ETF that's ever existed at 14.25%. And on top of that, you're also going to get a dividend of 2% as well. You know, a lot of stocks tend to be correlated directly with the S&P 500 or the Dow Jones, and a lot of people tend to look at stocks and say, which one should I buy? They're afraid maybe I'll pick GoPro, which I did. I picked GoPro, lost thousands of dollars. I don't want to talk about it. This is why I'm an ETF investor. Anyway, so VOO, it's great. You got to look into it, because at the end of the day, I think it's very important to just buy the entire broad market. You get 500 of some of the best companies. You get a low expense ratio, low turnover ratio. It's currently at 4.1%. You can't beat it. So if you guys like this video, please hit that like button and hit that subscribe button as well. And I really hope I gave you guys a new appreciation and understanding of ETFs as a whole. If you guys have any questions or disagreements, or if you think there are better ETFs out there that I missed, let me know in the comment section down below. Thanks guys, and I'll see you next week.